Today we are going to start this question. This question is relevant with business finance. GRAFFHAM company. GRAFFHAM company is relevant with what? It is relevant with the sources of finance, in which we will discuss equity financing and EPS and other relevant ratios uh, with the equity financing and impact on the debt as well. GRAFFHAM company directors are planning to invest in new project which requires $18.9 million. So they are planning to make investment in the new project which required investment of 18.9 million. Of the new finance to be raised, GRAFFHAM company directors have used a mix of debt and equity finance to finance recent investment, but have become concerned about the level of GRAFFHAM companies gearing compared with the industry averages. So they are comparing gearing ratio with the industry averages. Therefore, they have decided not to use debt finance to fund the new project. So they don't want to use debt finance to fund the new project. We all know that there is a theory which is called pecking order theory. Pecking order theory says that whenever you want to raise finance or funding to for any new project, first of all, you should utilize your retained earnings. If you don't have enough retained earnings, then go for the long-term financing or debt financing. And after that, at the end, you will go for the equity financing because debt finance has a fixed interest rate and as well as its issue cost is lower than the equity finance. Equity finance is the one which requires dividend or cost of equity, which is always higher than the debt finance or interest on loan. And as long as you will earn more profit, you have to distribute more dividend in the equity financing. And very importantly, interest on loan always attracts tax benefit. On the other hand, equity financing or dividend does not attract tax benefit. GRAFFHAM has proposed 2 for 5 right issues. So their proposal is 2 for 5 right issues to existing shareholders at a discount rate to the current share price of 8.4. 25% will be the discount and current share price is 8.4. Nominal value of the ordinary share is $2 per share. Nominal value means par value, base rate. However, GRAFFHAM company's chairman has received objections for some small shareholders owing less than 5% of the issued share capital on each ground that they do not have sufficient cash available to pay for the new share. So small shareholders are saying that they are not ready to purchase shares or right issues because they are facing shortage of finance. Then he says, GRAFFHAM companies have large shareholders owing more than 10% of the issued share capital each and 50% in the total of the issued share capital will be happy to subscribe for a right issue. However, they want the new project to earn at least the same operating profit margin in terms as GRAFFHAM company's current business does. Operating profit margin when measured as profit before interest and tax divided by revenue into 100. So here they are using operating profit margin. Financial statements information prior to raising finance. Revenue is 45.2 million. PBIT is 9.5 million. Ordinary shares are 15 million in total. $50 million. All values are given in 100,000. And then we have retained earnings 27,875,000. Non-current liabilities. Currently we have 8% loan notes. Corporation tax is payable at 16% per year. Nominal value of GRAFFHAM loan note is $100 per loan note and the market value is currently $110. GRAFFHAM company's price earning ratio can assume to be changed by undertaking the project. Current industry average gearing figures at market value measured at non-current liabilities divided by non-current liabilities plus equity into 100 is 25%. So this formula is used to determine, it is basically capital gearing, because in denominator we are using long-term loan and equity both. Whenever we are calculating financial gearing, we always say long-term loans divided by equity into 100. The new project is expected to earn 20 million revenue each year and have an operating profit margin of 18%. If the project is successful, there are expected to be opportunities to invest in further projects offering highest operating profit margin. So in part A, he says that calculate the theoretical X right price per share and calculate the current EPS before the investment in the project. So we need to do what? We need to calculate theoretical X right price per share, and second we need to calculate current EPS before the investment in the project. Okay. So first of all, we will calculate theoretical X right price per share. A1 TERP, theoretical X-right price, current we have 5 shares at $8.4 at $8.4. So here I am going to multiply 5 with 8.4. It is given in dollar value. 5 multiplied by 8.4. It is given in dollar value. Then we have right shares. 2 at the rate of 8.4 multiplied by 75%, which means 0.75 because there is discount of 25%. So 2 into 8.4 multiplied by 0.75. So we have what? 12.6. So now we will calculate total value. We have total shares 5 plus 2, 7. And what is theoretical X right price? It is $6. Sorry, it is not 42. 42 plus 12.6. So theoretical X right price is this divided by this. So we have theoretical X right price of 7.8. Theoretical X right price is $7.8. Then he's saying that calculate the current EPS before investment in the project. So next is current EPS. First of all, we need to determine current shares because EPS is equal to profit after tax divided by number of shares. And we are provided with PBIT and we are not provided with the shares. So we will start from current PBIT which is 9,500. If I also take in 100,000, so it is 9.5 million less interest. Currently, we are provided with only one loan, which is loan notes 25,000, means 25 million, and interest is 8%, so it is 2,000. Here we have profit before tax, this minus this, 9,500 minus 2,000. Then we will deduct tax, less tax at 16% into 0.16. So we have 66.3 million profit after tax. We are required to calculate EPS. So now we will calculate current number of shares, where we have 15 million in total. We are writing in 100,000 divided by its par value, which is $2 in the question. Here we have $2. So 7.5 million are number of shares. We can calculate EPS is equal to profit after tax divided by current number of shares. EPS is what? EPS is 8.4 million. Sorry, 8.4. So here we have answer of the second part. Then we are expected to calculate the revised EPS and share price after investment in the project, assuming the right issue is successful. Okay, so now we will calculate revised EPS. A3. Revised EPS, assuming what? Our right issues is successful. So when our right issue is successful, there will be increase in 18% profit margin of 20 million. New project expected to earn 20 million revenue and have an operating margin of 18%. So starting from, we can start either from revenue or either from directly from PBIT. So I am starting from PBIT. Current it is 9.5 million plus is 18% of 20,000 because we are taking values in 100,000. So PBIT is now 13.1 million. We have 20 million, we are showing in 100,000. So we have what? We have 20,000 into 18%. Less interest. There is no increase in loan and no bank overdraft is provided. So interest will remain the same, which we determined earlier, 25,000 into 8%. 13.1 million minus 2 million. Profit before tax less tax 16%. So 1776. So here we have profit after tax. Now we need what? We need number of ordinary shares. Current shares are 7.5 million. Current shares 7.5 million. Right issues. Right issues are basically what? Right issues are 245 right issues. 245 right issues means what? Currently 7,500 divided by 5. The one who has current 5 shares will receive 2 right issues. So there will be additional issue of 3 million as right issues, because we want to do what? We want to raise fund, but we are not interested to borrow funds. So that's why he's saying what? What will you do? You will raise finance to write shares. So here we have 10,500,000 right shares. Next is to calculate revised EPS, which is equal to what? Profit after tax divided by your shares. So revised EPS is 0.888. What does it mean? It means our revised EPS has increased from $0.84 to $0.888. So this is the way to calculate what? This is the way to calculate revised EPS. Starting from PBIT, if we are borrowing any loan, if we are borrowing any additional overdraft finance, then we will definitely revise our interest expense. But here there is no increase in loan, neither in long-term loans nor in bank overdraft. That's why there is no change in interest cost. PV profit before tax is given, then we are deducting tax, profit after tax, current shares, right issues, and we have revised EPS. Next is to calculate the gearing and current gearing ratio and the revised gearing after the investment in the project using market value and assuming the right issue is successful. Okay, so now we are required to calculate current and revised gearing, but on the basis of market values. And we need to do what? We are expected to follow this formula for the gearing, which is called capital gearing. So first we will calculate market value of equity, or we can say that market value of ordinary shares. Whenever you are calculating market value of equity, then there is no need to add retained earnings. So market value of equity is equal to what? Current number of shares, which we determined here 7.5 million. But we are using data in 100,000, so that's why we are multiplying with 7,500. Multiplied with current share price of 8.4. So 63,000 or 63 million is market value of equity. Then we have market value of loan note is equal to 25,000 divided by 100 multiplied by current market value of 110. So it is what? It is 27,500,000. So we have what? 90,500,000 is our capital. This is called capital or current capital. All these values are current. Now we will calculate current gearing, which is equal to market value of loan note divided by market value of loan note plus market value of equity. So we have zero point 0.3, or I will convert into percentage by multiply by 100. I can use this percentage sign as well, but I am using multiplied by 100. So 30.387 is your current gearing. Current gearing ratio is greater than the industry average of 25%. Now we are required to calculate the revised gearing when right issue is successful. So now revised. First of all, we have market value of equity. Basically, at the start of the question, he was saying which require 18.9 million to finance new finance to be raised. So it means market value of the right issue is 18.9. So here we can say that market value of equity is current 63,000 plus we are acquiring 18.9 million, which is based on market value. There is no need to multiply your right issues with the market value because you are not issuing at this value. You are issuing at 25% discount, which means at 75% of this value. And 75% of this value is 18.9 million. So market value of equity is 81.9 million. Market value of loan note is same 25,000, sorry, 27,500, which we determined here. So sum of these values is capital revised gearing is equal to loan note plus equity we have market value of loan notes divided by market value of equity plus market value of loan notes. So now we have 0.25. If I multiply with 100, so I have the 25.13%, which is almost close to the industry average or almost same as the industry average. Although industry average is 25%, it is slightly higher, but still we can say that acceptable because it is reducing from 30.38% to 25.13%. So there is reduction in capital gearing by 5% or more than 5%, which is a positive indicator because reduction in gearing ratio reduces the financial risk of the company. Reduction in financial risk always reduces shareholders' expectations towards return, and it reduces cost of equity. So this is acceptable because revised gearing is what? It is decreasing. Next, we have what? Discuss the views of the share directors and both the large and small shareholders in relation to new project and its financing. So large shareholders were willing to purchase shares, right issues because they have sufficient cash funds. Small shareholders are not willing. And director is saying what? Have used a mix of debt and equity finance uh, for the recent investment, but have become concerned about the level of GRAFFHAM current gearing with the industry average. Therefore, they decided not to use debt finance to fund the new project. So we determined the current gearing, which is definitely higher than what? Higher than the industry average. So we can say that directors' concerns are valid. So here we will write the answer. Current capital gearing of the company is 30.39%, which is greater than industry average of 25%. So we can say that directors' concern was right towards gearing in comparison with industry, and their decision of not to issue loan notes is also understandable, or we can say that their decision is correct. If they issue right shares, it will reduce gearing ratio to 25.13%, which is almost close to industry average. So this decision of issuing right shares is acceptable for the company. So here we discuss the director's views. Now we will discuss about the shareholders. Small shareholders are not willing to buy right issues because of shortage of cash and large shareholders are willing to purchase right shares. Small shareholders cannot impact the company, so it will be fine for the company to issue right shares. There could be concern of not treating all shareholders in the same manner, but currently company has no choice because they need to reduce capital gearing and risk of the company as well. So that's why we are saying what we are saying, that we are going to support this issue of right shares. So we are done with part 1. Once again, I am going to give you a summary of this question before moving further. Basically, this question is relevant with the business finance. And business finance focuses on what? It focuses on either to issue loan notes or to issue right shares or to borrow funds from the long-term loans or borrow from bank overdraft. In this question, we are restricted to follow right issues or equity shares or ordinary shares. In this question, he says that a company needs 18.9 million as a finance for the new project, but company just want to issue right shares. So that's why they are going to issue 2 right shares against current 5 shares, and they are offering 25% discount to their current shareholders, where current share price in the market is 18.4. So he is saying that there are 2 types of shareholders. A few are small shareholders and a few are large, or we can say half of the shareholders are small and half are large shareholders. Half of the small shareholders are holding less than 5%. On the other hand, large shareholders are holding more than 10%. So large shareholders are willing to purchase shares through right issues, but small shareholders are not willing because they don't have enough finances. Then he says that when we are going to make this decision, we should evaluate some calculations. First, we need to calculate theoretical X right price. Here we determine theoretical X right price, and theoretical X right price is 7.8. Then we determine what? Then we determine earnings per share, which is current EPS. Current EPS is 0.84. He says that after this investment, you will do what? You will make a profit of 20% on the revenue. So there is revised EPS and there is rise in profit before interest and tax by 18% on determined on this 20% revenue, 20 million revenue. And then we recalculate our profit and loss up till profit after tax. Then we calculate our current shares, and finally we have a revised EPS of 80.888 dollars. Then he says that determine current gearing and revised gearing on the basis of market value of equity and market value of loan. We determined market value of equity and loan first, and then we determined current gearing, which is 30.87. Sorry, 30.38, which is greater than the current industry average of 25%. So that's why the directors were not willing to issue further loan. Then we determined a revised gearing ratio, which is 25.13, almost close to industry average. So that's why we are saying that directors' decision towards the issue of right shares is correct, although small shareholders are not willing to purchase. And if we are going to ignore their suggestion or their opinion, and we are just following large shareholders, it is a biasness, or it could be inclined towards the influencing shareholders. But currently, company has no other choice, so that's why it is appropriate to issue right shares. Now we will go for the next part. Here he says that one of the GRAFFHAM company's non-executive directors has suggested using Islamic finance, either Mudarba contract, Musharka contract, as an alternative to the right issue. Discuss the use of Mudarba or Musharka contract as possible alternative sources of finance for the project. Basically, Mudarba or Musharka, or in fact, first of all, I would like if we explain what is Islamic finance, or what are the basics of the Islamic finance. Islamic finance basically requires from us that there must not be any fixed interest, or there must not be any fixed promising income, or interest on loan whenever we are borrowing from the bank, or whenever we are providing finance as a lender to someone. So Islamic finance prohibits first of all riba, or it says that it must be interest free. Secondary, Islamic finance always suggests that businesses should not invest on those activities which are considered as like illegal activities in Islam, which is called, we use the word of haram. Like, it does not suggest to invest in gambling, or businesses like which is where businesses are selling wine or any other thing which is considered as illegal product or service in the Islam. Secondary says that we have some Islamic sources of finances. Apart from this question, we should know that Islamic source of finance is Sukuk, SUKUK, which is an alternative of the loan notes, where don't have any fixed interest. In fact, profit or loss is determined on the basis of actual performance of the business. Then we have the alternative like Ijara, which is the alternative of leasing. Ijara is a concept of rental on the non-current asset. If you are going to purchase non-current asset from the bank, or you are going to acquire a non-current asset from the bank as leasing, which is called Ijara, you have to pay the rental on the use of that non-current asset. Third one is like we have Mudarba. Mudarba contract is one which is an example of like business angels, where one person is providing finance and the other person will provide skills. Basically, Islamic equity finance is more focused on such a contract which is called Mudarba contract. We prefer that whenever you are doing business, one person must be the provider of the fund and the other person is using his or her skill. And in this contract, only the person who is providing the funds will bear the loss, because the other party is just providing their skills and they don't have the finance. But in case of profit, both will distribute profit in between each other on the basis of predetermined ratios or proportions. And Musharka is like partnership, where all the partners are investing their finance, and as well as they will invest their physical efforts, or they will participate in the physically or in the growth of the business, in the growth of the revenue and profitability. So this is called musharka contract. Then we have a murabaha contract, in which you have the option to purchase on credit. So these are the different types of Islamic sources of finance. So here he is saying that, can we use mudarba and musharka contract? Yes, we can use musharka and mudarba contract. Mudarba contract is like issue of ordinary shares or right issues, where management of the company is managing the business, but they are not investing finances, and the shareholders are the one, or finance providers are the one who are going to finance the business. So it is what it is, like an agency theory, where one party is providing funds considered as a principal, and the other party is the agent of the principal, and they are utilizing their resources. And in musharka, they can use musharka, but whenever they are going to use musharka, then they have to make a joint venture where all the parties will invest, and all the parties will take risk, all the parties will take the responsibility of their liabilities, and they will put their equal efforts to secure the benefit from the project. So this is called what? This is called musharka contract. So these are the alternatives of derived issues, and yes, we can use these alternatives as right issues to grow our businesses.